downward revisions here?
Well, I totally agree with what's been said in terms of the fact that the first quarter numbers, we knew were going to be soft. The fact they're just a touch softer than expected. The most important thing is, when you look at the monthly numbers underlying this quarterly report, you see that the momentum was gaining throughout the first quarter. The weakness was really concentrated early in the year, on the turn of the year, and the numbers steadily improved. So we enter into the second quarter with some good momentum, and that really I think explains why most people are already looking ahead to the expected rebound in growth to above 3% in Q2.
But Michelle, shouldn't we be expecting something at some point from the tax code? I referred to it with respect to equipment purchases, but shouldn't some money be coming into people's pockets and that show up with some pretty substantial fiscal stimulus?
Well, I am more focused, as you said, on the implications for corporate spending than I am for consumer spending. It's very late in the cycle, and in that sense, I'm not sure there's a lot of pent-up demand on the consumer side that's suddenly going to be unleashed when consumers have a bit more money in their pockets. I mean, this isn't the kind. I don't think you can get the same impact on the consumer that you'd see as you normally do when you get fiscal stimulus coming out of a recession or when the economy is much weaker. So to me, the real bang for the buck is going to come on the investment side. And as we talked about, good capital spending numbers this morning or in the first quarter, building on strength actually seen in 2017. I mean, for the consumer, I want to point out that's actually good news. I mean, if we do get continued business investment, which leads to better productivity growth, that should bode well for wages. I mean, I do think it can come around where the overall improvement in the economy, being from a business investment-led standpoint, is good all around. And of course, it's important to note, if it's investment-led, it's not an inflationary type of growth that I think the Fed would be worried about.
Michelle.
So they're saying you don't need to worry about inflation, but I beg to differ. Obviously, consumer spending is not going to go up because consumers are laden with debt. We have the highest debt levels since 2008. And that's just going to continue because, unfortunately, most people can't afford just normal living standards. So a lot of people are using credit to live the life that they're living. And obviously, credit's going to be easy, so more and more people are going to be accessing it. And that's why a lot of asset classes are overvalued and leveraged. So I do feel like this bubble will continue for a little bit longer, but eventually it will collapse. And like I said, I do see the dollar actually becoming much, much weaker. It makes sense for the U.S. if they want to get out of debt to just, have inflation, because inflation will make it where even if you owe $1 trillion, if $1 trillion becomes worth only $1 billion or $1 million, it's okay. And I definitely see that happening. And what does that do to cryptocurrencies? That should bring the value up. So, like I said, long term, these corporations are just going to keep buying back their stock, and the stock market's going to look good. It's, numbers are going to obviously look good, but eventually it's all going to have to stop. The funny money will stop, and that's where I really do feel like crypto will shine. But let me know what you guys think. It's really interesting that the yield has actually gone down. It was at 3%, and it's now at 2.85. So will rates stay flat? I don't think so. I think that they're going to have to continue to raise the rates. But let me know your thoughts on this, and I will talk to you guys soon.